But the only thing that's going to vary is Section A. Look and see, is there an underwriting fee, origination, processing, or discount? So the top left section, that's where you need to look, and that's how you can make the best decision.
Someone had to ask. I'm Amy Viaclia, and this show is built on one idea that good questions asked of the right people make all the difference. Each episode, I sit down with someone who has the expertise most of us don't and ask the questions you might not know to ask. Someone had to ask, so I did. Today, we're talking about a moment that happens more often than people realize. You're working with a mortgage broker, they've pulled your credit, reviewed your finances, shopped lenders, and found a rate that works for your situation. Then your offer on a house gets accepted, and around that same time, your realtor mentions that they know a bank that can do a little bit better on the rate. Now you're stuck in the middle. Do you switch? Is the new rate actually better? And what does this moment mean for the relationship between your broker and your realtor? Two people who are both supposed to be looking out for you. Jay has been on the receiving end of this conversation more times than he can count. So I wanted to ask him directly, what's actually happening here? And what should a borrower do if they find themselves in this situation? Jay, welcome back to Someone Had to Ask.
Thanks for having me.
Jay, walk us through this scenario from your side. A broker has already done the work. You have already pulled the credit, shopped lenders, structured the loan, and then around the time an offer is accepted, a realtor mentions another lender with a little bit lower rate. What's actually happening in that moment?
Well, the realtor typically would have a relationship with that particular loan officer. And what happens is they most loan officers like myself, I keep all realtors that I work with up to date where our interest rates are, or a range on a weekly basis, twice a week. I send those out every week. So what happens is let's just say I put together a loan approval for you, and your interest rate's 6%. Let's just keep things simple. 6% even. There's no points involved. You have standard closing costs with title company fees. You have your appraisal. You've got your homeowner's insurance. You've got escrow account. There's lots of different fees involved in every mortgage. So what's happening is that realtor or friend or whoever told you this information that, well, ABC Mortgage has a rate of 5.75. So you're obviously going to be you're going to be intrigued. Everybody wants the lowest rate, and there's nothing wrong with that. There's that 5.75 is probably is accurate. It's being offered, but you have to get a loan estimate. It's that simple. You just have to look at the loan estimate and look at the APR. That'll tell you, who has the highest cost involved. So 5.75 might be readily available, whereas I'm offering 6%, but my 6% doesn't have certain costs involved. If you want 5.75, there could be costs involved. So that's the difference. And I will say this: after 23 years, when it's too good to be true, it always is. It's every time. If you get a quote, and let's say I've quoted you at 6% in your loan scenario, another loan officer quoted you at 5.875. Another quoted you 6.125. Okay, that's going to be accurate. That we're all right in the same ballpark. So whenever you get an offer that is half a percent, or let's just say instead of 6% or 5.875, they're all of a sudden they're offering 5.25. There's a catch to it. They're not lying to you. It's just that's typically what's called a teaser rate. It's exactly that. It's to tease you. It's to get your attention. And you've got to be really careful with that. And to be careful, you just ask for a loan estimate. That's all.
So you've talked about some comparisons like, APR and the teaser rate. That's interesting that it's, yeah, it would be a teaser because I've seen the teasers, but how would a borrower even know which rate is better? And what page did they flip to? And what should they be comparing on that loan estimate?
Okay, here's the thing, and any loan officer, any good loan officer with any experience would tell you, if you know that you are going to move within the next 5 years, you're going to refinance in the first 5 years, you need to go with the rate with the lowest cost involved. Okay, so if you know that you're going to refinance, you're going to always be looking for a lower rate, and your loan officer may have said, look, rates are probably going to drop, which right now they are. They're probably going to drop a 0.5% at some point. And a real life example I have on someone that is right now choosing between me and another lender is my loan estimate has the best rate available with no points. Now he's interested in buying points, but my advice would be not to buy points right now. It'd be a waste of money, and wait and just refinance 6 months down the road when rates might be a 0.5% lower, and then you won't be out any more money than you normally would. You can refinance and come to the closing table as far as the cost involved, what your new proposed mortgage payment would be. So you wouldn't be out any more money. So you just kind of wait. And it's just the old saying in my line of work is you marry the house and you date the rate always. You're not ever stuck. You're not always stuck with that same rate. You can date around a little bit with the rate, and that's where your loan officer comes involved and say, look, you can refinance, save $160 a month, $200 a month, and go about it that way. Um, and as far as comparing, it really depends on your situation. 100%. Everybody's different. I can't stress that enough. What person A does and person B are going to be two different things. You just don't know what the best solution is until your loan officer goes through everything with you. What do you have the means to put more money down? Do you need to keep more money in your pocket for the move? And that's where your loan officer comes involved and gives the options with different interest rates and different costs. But I hope that answers your question. As I think you were asking mainly, how do you compare different rates and that sort of thing? And it all comes down to cost, and who has the lowest cost for the rate, and are you going to be in the house for 5 years or more? And if you're not looking to refinance, you don't even want to think about going through the mortgage process again. Take the lower rate, pay a little bit more money up front. There's nothing wrong with that at all. Just because you're paying, even into discount points to get the rate a little bit lower, there's nothing wrong with that. As long as you plan on being in the house for 5 years or more, and if you don't want to think about it again, you don't want to refinance, don't even, then pay a little bit more up front. There's nothing wrong with that.
Tell me what some of those line items are. Like whenever they hear words like origination fee, or what are some of those terms that are those line items that someone should be, like kind of alert to that are those variable costs, whereas some of the line items totally depend on an outside agency, like the title search or whatever the case might be. What are some
Mhm.
of those items?
I love this question. I'm glad you asked me this because on any loan estimate, what you're looking at is Section A and Section B. Section A will have the one area on a loan estimate that will vary. That's really the only area that's going to have the biggest variation. Okay. And what those fees are is a origination fee, underwriting fee, discount fee, processing fee. Pretty much those four things. Okay. So those are really the only big variables on a loan estimate are those items. So origination, discount point, underwriting fee, and processing. And that's at the very top left of the loan estimate in section A. The rest of the fees involved are, title fees, appraisal, escrow, your homeowner's insurance. Those things are going to be the same no matter who you go with. It doesn't matter. You can get 100 different loan estimates to find the best deal, but the only thing that's going to vary is section A. Look and see, is there an underwriting fee, origination, processing, or discount? So the top left section, that's where you need to look, and that's how you can make the best decision. You look for the lowest rate and see what the lender fees are, So here's a real life example on a VA loan. There's a gentleman I'm working with, and I have his loan set up where he has no lender fees. The only fees and cost he has is for title and escrow and homeowners insurance, all the standard stuff that's going to be on every single loan. So he has no lender fees from me, no processing, nothing. And that's at a rate, 5.625, I think is where we are with him. It's a VA loan. Or I gave him the option of he could go down to 5.375 in his loan scenario, but here's the cost involved. So now all of a sudden that brings in discount points and maybe a processing fee. There'll be a cost involved. So what we do is we look at the break even point. And the break even point is figured between 5.375 and 5.625. So the difference in payment there is where we figure how long it's going to take him to get to his break even point, which in his case was about 4 years. So that's why I always say the rule of thumb is if you're going to be in the house for 5 years or more, take the lower rate if you can afford it. If you can afford the rate up front, and at 5.375 in this gentleman's case, might be the best deal. He might not, because 5.375 is fantastic. Might not even have to think about refinancing for a long time. It is better than 5.625, but the 5.625 has considerably less cost. So you've really got to weigh the odds. But to kind of circle back to your original question, top left section in section A and B, you want to look for the lender fees. That's the only thing that's going to vary.
Oh, wow. And then you think about the break even point, like if you are putting this much more down, like you're paying for those points, that's an interesting question to ask a broker. Like, if I went this direction versus this direction, where's that break
Mhm.
even point? That's really interesting.
Yes, it is. No, it is, and I think it's a good thing to look at. Just like I said, that there's so long that I've heard that the question of if I'm piling points, is that bad? No, it's not bad. I would not right now, personally, even if I had the means to put down more money, I would wait and just refinance. That would be my advice. Unless, let's just say we're at a historic low. Just say rates are historically low, which they were about 3 months ago before the Iran war situation popped up, and that spiked right now. But I just really believe it's temporary. So we'll get back down. So if we get back down to a low point, and looks like we're going to hover around that low point, say 5.25, because that's where we were. We were at 5.25 on a VA loan. I've got that particular loan in my head right now. So 5.25 is where we were, and I think we'll get back down there. So my advice to him, to this particular person I'm talking about, just wait and refinance, because you're going to be out a lot more money and not even get down to the rate we're probably going to be able to get you in a year, less than a year maybe. And you're not going to be out that extra money. You're just going to be out one mortgage. You're not even going to be out a mortgage payment. You're going to bring your mortgage payment to the closing table, cost wise. So you don't lose anything. It's just everybody wants the lowest rate right now. I would, I do too. I would too. That's exactly it. But if you can have just have a little bit of patience and know that rates are going to go down, just refinance. But I say that tongue in cheek, like discount points aren't bad, but then I'll kind of make it sound like they are. So it comes down to the situation. That's all it is. It does it one situation for you or one situation for me or somebody else. It's going to be different. It depends. Everybody's situation's different.
And that is so important for people to realize that when you develop that relationship with your broker, then they're understanding your situation. So let's come back to the question about realtors. What do you wish realtors understood about everything that goes into finding the right rate before a comment like that gets made to a client?
What do I wish a realtor would know? Well, but the realtors, the education that they go through and the certification they get really does hit on the mortgage process. So most realtors are really good at understanding the process. So I think the one thing that stands out to me would be incorporating how you could cover closing costs. That sometimes is a little bit of a mystery. Sometimes it really depends. Like in Kentucky, I don't run into it that much as far as when I talk to a realtor about, getting what's called seller concessions. That's whenever the seller covers the buyer's closing costs, and it essentially it's negotiated into the sales price. They're just basically financing their closing costs. But in another state, Virginia, whenever I talk about seller concessions, will they provide $5,000 to $6,000 maybe for seller concessions, and they kind of talk to me like, no, no, and it's kind of a weird, and it's a hard no. It's like, okay, like I did something wrong by asking, but most of the time, that would be the number one thing. How much a closing costs, and the realtor being good about helping negotiate the sales price with the cost involved to help the buyer uh, keep money in their pocket.
Oh, that's excellent. If someone is the borrower caught in the middle of this, what should they actually do? What questions should they be asking at that point?
With the realtor or just with me?
Oh, either one. What questions should they ask the realtor? And then what questions would you want your client to come back and ask you?
Okay. As far as okay, the thing to find out that the buyer talking to the realtor is finding out what's the rock bottom number. Where's their break even? Where's the seller's break even? Where they cannot go any lower. That's what they need to find out, in my opinion. And because if they want to roll in closing costs, then that way we know what the rock bottom number is, and we add in what their closing cost is to the offer. That's the best way to go about it, in my opinion. I would just get with the realtor, whoever you're using, and just cut to the chase and just say, look, what's the rock bottom, period. And then that way, because I want to be able to try and finance some of my closing costs. I don't want the seller to have to really, you know, think about this too much. I want them to get their money, but I need to roll in closing costs on this as well. So, I need to know that their bottom line number is, let's just say, 250,000. So if the realtor knows, okay, they'll take 250, that's it. They're not going any lower than that. Their closing costs are say 7,000. Now you offer 257. That's what the realtor should offer. It would be 257. That way the seller covers their closing costs. The seller still gets the same money and everybody's happy. So it doesn't usually go that swift because there's always a lot of back and forth. And but I think it's lots of times in reverse. You don't really find out what the seller's bottom line is until after a couple of different offers, and that's just the way it is. I'm just saying, in in a perfect standpoint from my vantage point, just find out what the rock bottom number is and go from there. But Oh, and another thing on offers that I see, um, and I think every realtor, they're going to know this more than me. I don't have my realtor's license, but I can tell you this: every time I talk to a buyer that tells me, and I have them approved for 300,000, just an example, and they see a house for 280, and they tell me, I know I'm just going to offer 260, and I go ahead and say, you're not going to get it accepted. It's not going to happen. It's just that is not how it is today at all. Most people selling their house, have their numbers in mind, and you coming in, 20,000 less, you can do it. I mean, if you want to do it, do it. But coming in 20,000 less is typically not going to work. You need to stay within $10,000, in my opinion, um, of the asking price. I mean, so, and I mean, the old saying, it never hurts to ask, of course. But in all reality, from what I see on a daily, weekly, yearly basis, is offers get accepted. When you stay within that $10,000 range, typically.
You've raised up a lot of answers to a lot of questions, but I also have more questions. And Jay, this is exactly the kind of moment I think a lot of people have experienced without ever understanding what was really going on when we're thinking about the relationship between the realtor, the broker, the client. You're both trying to take care of a client, and that client wants to be taken care of. If you are someone who's been in this position, caught between a broker and a realtor, unsure who to trust or what to ask, I hope this conversation gave you some language for it. Because as we talked about in episode 1, the question you don't ask is often the one that costs you the most. If you found this conversation useful, share it with someone who might need it, someone in the middle of this process right now, or someone who's already been through it and still has questions. Next time, we're talking about the bill that shows up at the very end, closing cost. What's actually in that number, and what surprises people most when they see it, and how to know what you're being shown is the full picture. We'll leave it there for today. Someone had to ask, so I did.